let's take a look at Ruth's Hospitality. This is, like you said, it's a steakhouse company. They've got what, about 100 in their chain. I'm going to zoom in to like a 6-month chart because as you can see, this company's been chugging along, which is perfect for our strategy, right? And you can definitely see what we were talking about with those lines of support and resistance. Every time this underlying symbol gets to a certain price, buying occurs. And every time it gets to another certain price, selling occurs, buying occurs, selling occurs. And it looks like we're at that level where we're going to start seeing some selling. So what should we do? Whenever you're at that level, you should sell. And so we want to sell to open some positions. Now, Ruth doesn't have the option chain that some of the other candidates like Mattel and Delta Airlines. It doesn't have those type of following. So we're somewhat limited, but not completely. So here's my instructions. Let me go ahead and put my instructions up on the screen. And of course, remember, I'm always going to say this. The trade I'm going to explain here, this is for educational purposes only, not considered advice or any endorsement to purchase or sell. We just want you to follow along with the trade. And especially, if you put a plan together on this, similar to the one I'm going to give you, make sure you back test and forward test it before you invest any real money. Make sure you know what you're doing because we are not in a place to be giving advice. Okay, good for that. Let's talk about it. So on an end of day fast MACD crossing with follow through or on a fast reversal. So those are two techniques we talk about in my program on how to identify if we are really at the top or not. When we identify that we're at the top, and I feel like we might be doing that next week, we're going to sell to open or short 500 shares of Ruth stock. Now, if you've got a bigger portfolio, that's about a $10,000 investment. If you've got a bigger or a smaller portfolio, you'll adjust accordingly to keep your risk in place. But here's where we're going to do the same thing as those hedge fund traders. We're going to place a stop loss order. And in this case, the stop loss order is going to be a buy to cover if Ruth goes back up and crosses above $21. So let me make sure you know what I'm talking about here. Here's Ruth. Let me get rid of my chicken scratch on the screen. And so once we identify, and I gave you two different ways that we like to identify tops. Once we've identified the tops, and it looks like that's going to happen early next week, then we're going to go ahead and short some shares of Ruth. That means we're going to sell to open, and we're going to go ahead and put a buy to close stop loss order triggered on Ruth going above $21. That's going to protect our risk, right? Now, what are we going to do after that? Everybody knows. If you've been following along, you know that we're going to wait. We're going to wait a little bit as Ruth drops in price. And once it drops to a certain level, one doesn't really matter what that level is, but once it finds its bottom, we're going to then sell some put premium against it. And I've got the Ruth January 21, $17.50 puts. And as protection, I'm going to put the call options for May in place at the $20 call. So now I've got the shorted stock, I've got put premium sold against that, and I've got call options hedging it. And then I'm going to wait. That put premium is going to expire on the third week of January. That's our payday. And that leaves us with the call. So when we find another top, we'll go ahead and close those call options, probably at a profit. We don't need them anymore once the premium expires. So we can get rid of them, and it'll give us a profit. It'll give us frosting on the cake with our strategy. And then we'll see if we can do it again and again on that shorted underlying stock. So that's really our whole plan in a nutshell. We're just going to be following Ruth. At the top, we're going to go ahead and short the symbol. At the bottom, we're going to sell put premium. Now, I did get a question, Sip. Folks were asking, what if it just goes so far down should we still short the premium? And I would say if it goes below $17, no, don't sell the premium. Just buy to close your shorted symbol at a profit. But if it stops where it stopped before, that's a perfect opportunity to go ahead and sell premium, buy your protection at $20, and allow that trade to start giving you income every month.
Yeah, I like this setup. I like the stock price. That support right there, or that resistance right there is looking very thick.
Yeah,
Um, and just them being in the industry of hospitality, there's a lot of risks that come along with that these days.
yeah. Yeah, and don't worry. I mean, the scoop is we've got our buy to close order just like those, hedge fund traders we talked about on GameStop. We've got risk protection here, but also once we sell our premium and buy our protection, that and we'll maybe talk about that on a future show, but that protective call now passively protects us against risk, whereas that buy to close order was actively we've got them both in place. Now you're double protected. You've got your belt and your suspenders on.